Well, good afternoon, everyone, and good morning, good day, good evening to everyone, and welcome to this last presentation in our Trading Around the World series focusing on the CME Group E-micro Forex future product. But before we get underway today, I'd like to give you, and those of you who may not be familiar with the Interactive Broker platform, just a brief introduction to what our company does. Now, Interactive Brokers Group, actually, let me move this over. I do have even some slides. Now, Interactive Brokers Group is an automated global electronic market maker and broker that specializes in routing orders plus executing and processing trades. Our mission, as you can see on the screen, is actually to create technology to provide liquidity in better terms and also compete on price, speed, size, and diversity of global products and advanced trading tools. In the U.S., our business is conducted from headquarters in Greenwich, Connecticut, as well as from Chicago. But we also have offices located in Canada, in the U.K., Switzerland, Hong Kong, India, Australia, and Japan. And as an electronic broker, we execute, clear, and settle trades globally, not only for individual clients, but also institutional ones, such as regulated asset managers, funds, proprietary trading groups, and even investment firms, as well as banks or introducing brokers. Some more facts about IB is that we've been in business now for 31 years, building direct access trading technology to deliver real advantages for trading professionals. IB currently holds $4.4 billion in equity capital, and we are now the largest independent U.S. broker-dealer. We are able to offer you lower commissions, lower margin interest rates, and higher interest paid due to the fact that IB has automated every aspect of the trading process in-house. Our customers receive worldwide direct access connectivity from a single IB universal account that provides you trading access through our proprietary feature Trader Workstation. Plus, you can also use our application programming interface functions as well as the industry FIX standard, which is short for Financial Information Exchange. Plus, IB clients are protected by 30 million securities account protection provided by SIPC and Lloyd's of London. Now, since launching the electronic brokerage business in 1993, we've grown to approximately 111,000 clients. Plus, here you'll see some of our key highlights of our electronic brokerage business. Starting with the low cost, we actually provide our customers among the lowest transaction costs in several ways. First, clients benefit from the advanced routing of orders designed to achieve the best available price at the time that you place your order. Second, we also offer the lowest execution, commission, and financing costs in the industry. Now, also, we have risk control that throughout the day we do calculate margin requirements for each customer on a real-time basis across all product classes, including stocks, options, futures, bonds, and even Forex, and across all currencies. Now, our real-time margin system continuously enforces limits for each client account, automatically liquidating positions if any account violates its margin amount. This is done to protect IB as well as to protect all of our clients from excessive losses. Plus, we have a universal account that allows you to trade various assets denominated in multiple currencies, all from a single account. We have smart routing that searches for the best price available at the time of your trade, and unlike other routers, will actually dynamically route and reroute all or parts of your order to achieve the best aggregated executed price. There's a lot of other features that are available, but don't want to take up too much time right now, and just let you know that we provide trading access on over 80 markets, and you can find the full list of all exchanges that are available on the Interactive Brokers website. There's actually a trading menu there that you can access all of these exchanges, including the CME Group, which we're going to be talking about today. Now, if you do have any questions about IB's platform, and here's just a quick screenshot, I will be on hand and we'll be going into questions and can actually view the platform after Tim's presentation. So with that, I'd like to turn this over to Mike Homan with the CME Group to give you a few of the contract specifications on the features of the E-micro future E-micro futures, that we're going to be discussing today. So, Mike, I see you've unmuted your phone. I'm going to pass you the ball so that you can tell us a little bit more about what we're going to be looking at today.
Thank you very much, Cynthia. It's a real pleasure to be on this call with you and everyone else here. And CME Group is really appreciative of all of the efforts that you have done so far. So, moving forward, basically the E-micro FX futures came out March 22nd of this year. Some of the benefits of the E-micro, it's trading in a regulated market where you have credibility of quotes versus some of the cash FX platforms. You have fully transparent markets where all bids and offers are fully transparent through the Globex network, unlike some of the cash platforms where some of the bids, or mostly the bids and offers, are different for each participant. You have individual protections such as counterparty credit risk and safety and segregation of customer funds. You have a fair and level playing field, whereas if you're an individual trader or an institutional trader, if the individual trader is first on the price, the individual trader is going to get filled. Unlike cash platforms where they tend to skew the pricing, and depending on if you're a big player, you may get filled first. This product trades exclusively on the CME Globex platform, which delivers millisecond response time. And finally, you don't have to pay the daily rolls in the cash, whereas if you buy or sell the E-micro contract, you're able to hold that contract open for a quarterly period. Now, right here is the E-micro Forex futures contract specs. We can, we can talk about this later. If you have any questions or concerns, you can contact me direct. My name, phone number, and email address will be available. Basically, an overall view is the 6 major currency pairs, roughly 1/10 the size of our current standard contract, quoted in interbank terms with roughly 1/10 the margin, which is a really important feature for maybe traders who have just started. It's not really a capital intensive contract. For $600 you can have you're able to trade 1 E-micro FX euro, for example. So very affordable, and it's our liquidity is building daily. As of June 5th, we had a new contract volume high of 10,573 contracts. So we're very excited about the initial launch and the initial take-up from the retail trading public and even prop groups and even some small CTAs. So we're very excited about the progress. Right here again is just a little overview on the margins. As you can see, they're very reasonable, ranging from $473 to about $270 US. So with that being said, I'd like to introduce a friend of the exchange, Tim Morge, who's president of Blackthorn Capital. He's here today to talk to you about high probability Forex trades using median lines and trend lines and Fibonacci retracements. So with that being said, let's welcome Tim Morge.
Hi, Michael. How are you?
Good, Tim. How are you?
Can you guys hear me? I'm good, Mike. You can hear me fine?
Yes.
Because I hadn't done a sound test. Can anybody in the audience hear me? Let me just double check. Okay, great. I just wanted to double check. Great. Nice to see all of you. I appreciate you taking time. I know it's a busy day for everybody. Some of you, this is your 4th session today. Mike, you must be having a heck of a day at the CME, huh?
Yes, we're having another very good day.
Great. Somebody said low volume issue on the micros. Actually, the micros are going, if you remember the E-mini S&Ps, the micros are going leaps and bounds. Wait a couple months, you'll just be shocked. So, don't just get turned off because you look at a screen and wonder. It's all good. Let's go ahead and take a look at some tools that will help you take a look at this, especially in its early days, because if you pull those charts up right now, here, let me just pull these up while I talk. Here, I'll give you a couple tools to use. If you pull up the micro currency futures right now and take a look at them, you might be a little daunted when you look at the chart and say, you know, this doesn't look the same as the big CME currency FX futures. It doesn't look the same as my cash chart. Okay, that's true. In the middle of the night during Tokyo, it's not quite as liquid at the moment. You know, there are times in Europe when it's not quite as big. But during the U.S., it's pretty much the same chart. So you can do a couple things. You can chart during the day. You can chart on cash and execute in the micros. You can chart the big CME contracts and execute in the micros. Now, if you want to do that, let me give you a couple tools. This is one of my favorite pages. If you've never seen this page before, you can see the equivalence page up there. It's www equivalence, et cetera, et cetera, et cetera. Or you can email me or Mike, and we'll both send you there. Or you'll see it in the recording. And what it allows you to do, are we not seeing my charts? Somebody's got to pass me the ball, I think, maybe. Did I do the wrong thing, Cynthia?
No, I did. Sorry, Tim. Now you have the ball.
Okay, now can you see the equivalence? Sorry about that, guys. Well, at least we weren't in the charts and I was pointing to myself. Okay, here we go. Sorry about that. Okay, so here we go. Nothing I can do about audio. I'm sure somebody else will take care of it. We're looking at a page called the equivalence page, one of my favorite pages. This is a great page that the CME puts together. And what it allows you to do is take a look at the cash foreign exchange market, biggest market in the world, and take it and say, okay, if I'm going to trade futures, what's the equivalent in cash? And it tells you an average of 5 or 6 major banks. It tells you what their forward points are. All you have to do is plug them in, hit forward points, and it's there. It's right in front of you. You can go down the entire list. Whatever you trade, it's there, ready for you to use. And mine is not live, so I can't hit the page and go back and look. But you can look at all the currency pairs you want to trade down there, and it'll show you the forwards that they trade on the mercantile exchange. Now, why is that good if you're going to use the micros? Well, you can do the exact same thing. So let's take a look. As I said, if you don't know about this page, you can just go to the CME page and look up equivalents, or you can either drop an email to Michael or me, or I'm sure you can, if you can't read this, you'll certainly be able to read it in the replay. Let me go to the next page. I've done a thing that I use myself. If I want to use cash, I have what I call a cheat sheet in front of me. This is my old days at First Chicago, when the First National Bank of Chicago was around, when we used to arbitrage the CME futures price to the cash price. You just put in the cash points right here, put the cash price in, put the forward points, hit it, and it'll run a whole Excel spreadsheet, and it'll tell you the whole thing right here. There's the equivalence link right below. Michael just gave it to you. If anybody ever wants a copy of this, you drop me an email. I'll drop you no spam free. You can just have it. It's fine. It used to be on my website. I don't think it is anymore, but just drop me an email. We'll send it to you. And, you know, I use it all the time. If I'm trading on the CME, I go, okay, what's going on in the cash? You know, if I'm trading in the cash that day, I want to get in at 87 in the cash. Oh, what's that in the futures? Well, that happens to be 85 today. So this is just, it's a good cheat sheet. You can make it up yourself. It's not hard to do. You can send me an email. It doesn't matter. No advertising. It's just an easy tool. Now, another way that you might want to think about this. Again, if you look at the charts and you go, boy, this micro chart looks a little bit thin to me, well, go to the biggies, chart either the big CMEs or chart cash, and then do the conversion. You can either do the straight conversion. Now, remember, cash and the micros are the same, but if you want to do the conversions to the CME futures contracts, in some they're the same, like in Australia, British pounds, and Canada you have to invert.
Actually, Tim, it's going to be Euro, British, and Aussie, which are the same in micro.
Right.
Yep.
And then Canada you're going to have to invert, right? And yen you have to invert, right? Am I wrong, Michael?
Canada, yeah. Swiss, and yen you're going to need to invert the standard contract.
So you just invert them, and I like to actually do invert times 100 on the yen, because there's too many zeros for me, my eyes get crossed. And again, you want this page, just send it to me. But I mean, you can set this up in 2 seconds for yourself on Excel. It's no big deal. But I have this in front of myself. If I go, you know, if you want to build a custom, a little custom chart, if you will, that shows you can chart the cash as the micro prices or as the future prices. Just build a little custom thing in either TradeStation or whatever. So those are tools that I use. Don't get confused. You know, use all of the various resources if you can to do whatever. Do I do the same with the equity indexes? it's out of the scope of what we're talking about. And let me, actually, Cynthia didn't mention this. Let me mention it. So that we don't go 900 hours tonight, we're going to take questions at the end. Otherwise, I'm going to be here, because I tend to, unfortunately, answer questions as you ask them. So instead, what I'm going to do is I'm going to ask you the whole questions, then we'll do them. No, it's all right. Don't be upset. Nobody said anything. We'll answer questions at the end, and I'll answer as many questions as you have. So let's go ahead and take a look at some trades now. And we want to take a look at methodology. The Canadian dollar has been a hot little currency to trade recently, and yes, somebody said earlier, and I'll hold it out, I'll put it in public. Michael, you can hold me to it. The last time the loonie, or the Canadian dollar, got to parity, the Canadians threw a party in downtown Chicago. I don't know if you know that. Well, I'll be the first American to stand up. It's our turn. If we get to parity, I'm buying at the Merck bar. Michael, you got that?
I'll hold you to that one.
I'm buying for a whole hour, anybody that shows up, okay? So here we go. Let's take a look at the Canada and see what we can see. So let's say, one of the most exhilarating rides that we can take as traders is when a profitable position we have on goes vertical. It's like being on a roller coaster. And you can see the edge of the fall coming. You can feel the breeze in your hair start to pick up, and suddenly your stomach lurches and you feel that move accelerate. You're in the free fall, and the further you fall, the faster you fall, and the more profits you put in your pocket. There are very few parts of trading that give me any adrenaline rush after being a professional trader now for more than 38 years. But catching a move just before it goes vertical is one of them. Now, there's a problem with vertical trending markets, of course. They often take off before you find and execute a high probability trade entry. No, we're on crude for a reason. Just hang with me. Sometimes you take profits right before they tip over the edge and go vertical. Many traders just cannot find high probability entries once a market goes vertical. Let's see if we can look at some recent trades in a pair of markets that are now trending in a vertical fashion and find ways to enter in the middle of these vertical trends. Now, yes, somebody asked why crude. Well, Canada produces 3 times as much crude as it uses. It's highly correlated. So when I trade Canada, I always take a look at crude. So let's talk about it. This first chart is crude, and I don't trade it one-to-one. I just want to get a feel for the big picture. This first chart is crude oil futures, plotted using bars that are $1.90 in range of price from high to low. By choosing price range bars, I've taken time out of this chart. And I use this charting technique when markets tend to trade in fits and starts because the dead periods can skew the charts, making drawing tools less accurate. My original long entry in crude oil futures was very near the bottom. Those of you that are in a lot of read a lot of my web pages or see me on Twitter know that my son Sean prodded me into getting long at $35 a barrel in oil. And I just actually got out yesterday at 71 1/4, and that goes directly into Sean's college fund. I actually took it out a buck early because I knew I was so busy today. So, and although we got above 72 1/4 today, my original long was just 35 bucks. On a normal chart that uses time versus price, this move looks more vertical in some areas and then stalls and trades in a range in other areas. But using these price range bars, the move seems to unfold in a more orderly fashion. Now, price climbed above the $53 a barrel and then formed a series of 3 lower highs and 3 lower lows. Let me see if I can get a cursor here. You know, Cynthia, I'm having, oh, you know, it's because I'm in the wrong place. There we go. Wake up, Tim. We climbed above $59 here, $53 here, excuse me. And then he formed a series of 3 higher highs and 3 higher lows in here, right in here. I added to my long at 48.04 here, or at 49 with a stop at 48.04 here. And now we zoom out of this. It's a sideways trading range with a slope, if you will. And we just kind of zip out of it. And then we get into a actual horizontal trading range, which is what you normally see. And when you see these, you should think of these as trading ranges, just as these are trading ranges. They just happen to have a slope. Don't let the slope throw you. So once price sprinted higher and approaches the multiple tops, I took profits on a third of the position at 53.50 up here. And I put a profit stop on my position at 53.50 once we got up in this area, up above the congestion. Oil prices then entered into a trading range between 56 and 60, which is right here. And I think that's natural. It's natural demand for oil at the moment. Now I put a new stop. I try and buy as soon as we break out of this range. I get long at 59.90, some additional oil. I put a stop at 58.40 because I think there's a normal buying in this area. Now I want to let this run. I've got all of my stop profit on the entire position up here at 58.40. I want to quickly take a loss on any contracts now if we break back into this trading range. If we break back into this trading range, especially if we break below, I don't want to have anything to do with oil. I think it's going to sprint up here and meet a measured move, but if we start to get back into the trading range, I just want to be done. Now, as you can see, the top of the prior range did act as support. We came back down and tested it. I gave this live during the CME Monday free webinar, so I did 3 days in a row. Buy just under $60, put $1.50 stop on it, you're home free. I was able to get long additional contracts at 59.90. My stop loss was never in danger of being executed, and crude closed, well, now we're at 72 and change. As I wrote this article, we were at 66 down in here, and now we're all the way up in here. And I wrote this last week, at the end of last week. So now let's look at a correlated market that's gone vertical and see if I can show you how to find quality entries once the market goes vertical, which is why it's really important. So we're going to look at the Canadian dollar against the U.S. dollar. So here's a look at the 240-minute bar chart of the Canadian dollar against the U.S. dollar. And you can see I found 3 great entries in this longer-term chart to enter and then add 2 additional legs to my longer-term portfolio position in this currency. Now, we're not actually going to be talking about, in the long term, we're not going to be talking about this portfolio trade. What we want to know is if you can't grab it on a portfolio basis and afford these biggest stops, or if the vertical move's already started, is there another way in? So now when crude oil is trending, you can bet I'm also trading the Canadian dollar either against the U.S. dollar or against the Japanese yen, because the Japanese yen use 4 times as much. They're the 4th largest user of petroleum, but they don't produce anything. Now, by using this outer warning line, we have the median line here from this high, this low, and this high. Here's the median line right here. Then I run another line, which is the same distance from the median line to the upper median line parallel. Here's the warning line right here. By using the outer warning line and waiting for my favorite entry to test and retest of the warning line, I find the first 2 entries in this monster move down, meaning the Canadian dollar is strengthening against the U.S. dollar, and the 3rd entry came at a test and retest of the major red sloping median line right here. Test and retest right in here with a very small stop. These are very high probability trade entry setups, and if the stops are acceptable relative to my perceived profit targets, meaning that the risk-reward ratios are higher than 4 or 5 to 1 when position trading, I take these trades every time I see them. But what do I do, or what do you do, if you're using smaller time frame charts and price has already gone vertical? Is it over? Can I not catch it? Somebody asked that earlier. Well, it's gone so far. Can I get in? Let's look at 20-minute charts of the Canadian dollar and see if we can find quality entry areas even though price has gone vertical. I can't even say intermarket reverse correlations, but okay. So now price falls in a near vertical fashion here. You see it? There's just nothing to do here. And then forms a counter trend rally to about 113.60 before trading to new lows. Now we run to 2 new lows down in this area. When price breaks below the prior lows around 111.80, I add a new downsloping red median line. We break below here, trade all the way down to 111.80, and I add in a downsloping median line from this high, this low, and this high. Now I watch as price comes down to test the downsloping red median line several times, and you can see it bouncing off of this median line. These tests tell me that this line is meaningful because it's acting so well as support. Then price turns and heads higher, testing and breaking above the red upper median line parallel. And notice, I didn't just put an order to sell straight here because I want to see what happens. And if you watch this in real time, it blew through here quickly. I want price to turn and show me that it's got some weakness, and we'll see that in a second. Now, I had a simple calculation from the lowest low to the latest swing high. So I go to this low, up to this high. I find where the 38.2% geometric or fib retracement is. I call it geometric because Euclid invented it. If you're Italian and you want to call it Fibonacci, that's fine with me. This area will attract many limit sell orders, And I want to watch this area carefully to see if there are enough limit sellers to stop the advance of price. Now, price tried 3 times to break and hold above this level. Take a look. 1, 2, 3. But it was unable to stay above it. There are lots of limit sell orders sitting at this 38.2% retracement area. Everybody wants to get short here. Now I add in the sliding parallel off this spike high when prices trades down below it. This line has the same slope as the median line. And I may be able to use this line if price shows any sign of weakness. My sign of weakness, or tell, comes when price breaks below the recent trading range here to test the upper median line parallel from above. So we come down and retest it from above here, and it holds. Note that this upper parallel now acts as support, so it gives me confidence that these sets of lines, including the sliding parallel up above, is carrying the same frequency as price. Now, given the chance, I'm willing to enter trades off of these red down-sloping lines, but I have to find a high probability trade entry setup I recognize before I'm willing to play. Now price gives me the opportunity I always look for, a high probability trade entry at a tested line. I get long Canada here, or short U.S. at 112.30 at the retest of the red down-sloping sliding parallel, and my initial stop loss is above the 3 attempts to get and hold above the 38.2% retracement area, as well as above the 38.2% retracement area itself, where I believe there are lots of limit sell orders still sitting that will protect my initial stop loss order at 112.62. So I have the limit sellers here that act as support, or excuse me, as resistance. I have these prior highs, and I've got this spike high. All of these should hold limit sellers. My order's up above there. I'm going to hide behind your orders, if you will. Now remember, markets that are selling off in a vertical fashion that are unable to climb above the 38.2% retracement are extremely weak and are likely to continue to move lower in a near vertical fashion once the shallow pullback is complete. Now the reverse is true, obviously, in strongly uptrending markets. If you can identify a high probability entry at or near the 38.2% area after it's been successfully tested, you don't just want to throw it out there. It's generally a tremendous entry opportunity. Let's see how this one worked. As you can see, once price failed to make it back to test the 38.2% retracement area, it returned to its vertical down move. If you managed to get on board at or near the 38.2% retracement area, as I did, it's now a matter of deciding how and where to take your profits. You can take your profits at prior lows. You can attempt to let your profits run all the way down to the measured move, where AB times 1.618 from C gives you a target of about 108.35. Or you can keep boxing in profits, lower your stop profits every time price leaves a clear swing high. You can see I did it in the green here. And simply let the trade run lower until either your profit stop gets executed or your limit profit gets executed. Now, I was currently using a profit stop above a prior swing high at 109.51 right here. So if my profit stop gets executed, I'm short this position at 112.30, and I'll get profit stopped out at 109.51 for a net gain of 279 pips. That's the worst that can happen to me. Any of these profit methods would have been more than acceptable, as long as you use a consistent method to take profit to keep a quality risk-reward ratio. You can make good profits trading in vertical markets. Stop-loss orders are a must anytime you trade. But they are especially important in vertical markets because the moves in both directions can be extremely explosive. It's extremely important to control your losses and keep them small relative to your profits, or you won't be in this game very long. Now, even I take Saturday and Sunday off, so that's the weekend break. Now we're back on Monday. As I finished the last slide, the position was not closed, and I showed several ways to book profits depending on your trading style. Let me show you how I booked profits in this trade. I chose to let my profits run. I boxed in profits by hiding stop profit orders above each swing high until price finally tested the red down-sloping median line, where I locked in for 139 pips of profit. Right here. I'm out. Once I've taken my profits, does the fun end there? Is it over? I call this riding the slide. Of course not. The market's always moving, and I find that if I'm patient and attentive, there are lots of trades that come along. An old mentor of mine once told me that if I could learn to successfully trade the squiggles inside a trend, there are times when I would be able to make 2, 3, 4, or even 5 times the profit I would have made if I'd simply sold the top and bought the bottom in a long downtrend. Obviously, the reverse being the case in an uptrend. Now, not every trader has the ability or the capital to hold longer-term positions, and I should also mention that not every trader has the ability to trade each squiggle. So each trader should find a style that fits their talents, but that's another article or another session for us to talk about. So while preparing to give my pre-market charting session in the morning for the Merc, the next morning, I noticed that the U.S. dollar had rallied against the Canadian dollar to test that same downsloping. We're right back up again. This is that same downsloping upper median line parallel, sliding parallel against the upper median line parallel that I sold against before. And I noticed, hey, it's right back up there. But I got to go give my market talk. So I kind of peek back and forth on doing my market talk. Now, as I concluded to get ready for the live session, I kept coming back to the Canadian dollar chart and take a look. Price was dancing around the downsloping sliding parallel, but it hadn't yet shown me any sign of weakness. I can want it to turn at this level, but it's got to show a sign of weakness. Until it did, I wasn't interested in entering a trade. Then price broke below a swing low. Let me show you. There we go. And it was beginning to look like I might get another opportunity to ride this same slide lower. Let me show you what I saw. Now, one of the concepts I worked over and over in my live morning trading sessions and when I mentor traders is that the market is always right. Now, this sounds incredibly simple-minded. But remember that to be a trader, you have to possess a certain amount of ego. And it's easy to feel that if you think price has reached the place where it should turn, it will turn. But the truth is there are many times when price has a mind of its own and your best laid plans end up ruined. One way to limit the damage is to let price play its cards before you enter a trade. And by that I mean that if you're looking to go short against a particular line, let price approach that line, dance with that line, and then let price show you that that line is beginning to show it is beginning to show weakness against that line before you place your order to get short. In other words, don't just sell a line naked or without letting price touch it. Let's see what price does first. So you can see price approach the black downsloping sliding parallel and push through it a handful of times. But it was having trouble making any further progress above this downsloping sliding parallel. And after a handful of bars, it began to trade below the sliding parallel. And when it broke and closed below the prior swing low, here, in my mind, price had played its cards, and I was ready to try to catch another ride on the slide. So my orders are quite simple. I want to sell a retest right here of the black downsloping sliding parallel at 109.45. My initial stop loss order will be 5 pips above the recent swing high at 109.78, so I'm right above here. If I manage to get short U.S. dollars long Canadian dollars, I'll use a profit target of the prior lows that we just came off of right down here, 107.94. I'm going to keep it very simple. I double check my math, then I put my limit sell order and my initial stop loss order at the same time in the market. I always want to be protected. And then I started my live market map session. I couldn't even watch because I had to go to a session. But that's okay, I'm protected. When I began charting the currencies during the live session, I opened a new 20-minute chart of the Canadian dollar and found much to my surprise that the limit sell order had already been executed, getting me short the U.S. dollar against the Canadian dollar at 109.45. So now I'm short. That's good. And now I got to try and pay attention to the session I'm in. Now the trade's going quite well. I still had more than 30 minutes of live charting to present, and price was beginning to sell off. I couldn't simply watch my new intraday position while several hundred traders were watching live, waiting for me to move to the next market that I was analyzing. So I showed the live internet audience the new position, and then while they watched, I canceled my initial stop loss order and moved my stop order to break even. I got to do some protection. After charting a handful of commodities and beginning to chart the stock index futures, I told everyone online, geez, you know what? I have to peek at my new intraday Canadian dollar position in just a second. The U.S. dollar had plummeted, and the position was near my profit order at 107.94. I briefly considered actually just going to the market and taking my profits. But that's really against what I teach and how I normally trade. I don't like to change my plans. So instead, I canceled my break-even order and changed it to a stop profit order 10 ticks above the swing high at 108.81. So here's the swing high, and I put my stop, my new profit stop right here at 108.81. Then I went back to charting the stock index futures, eager to finish the live charting session, and then get back to trading. So let's see what the market did while I finished up my charting session. After I finished my charting session, I pulled up the Canadian dollar chart and found that the U.S. dollar had mounted a nice rally. Price had just missed filling my profit order, but now it had climbed back against me about 50 pips. Wasn't that excited. I watched as price got closer and closer to my profit stop at 108.81, and I was pretty certain my profit order was just about to be filled. But, you know, it wouldn't be the end of the world. 108.81, I got short at 109.45. It's not that, you know, I'm not going to take my wife to the best restaurant in town that night, but it's better than McDonald's. Instead, price came within 2 pips of my stop profit order, turned on a dime, and headed right back down. Why would that be? Well, there were prior sellers at these swing orders, and that helped buffer the rise of price. 4 bars later, price retested the prior lows. My profit order at 107.94 was filled for a nice profit of 151 pips. There are 3 keys to this type of trade. There are lots of squiggles to catch, even in a near vertical trending market. Wait for price to play its cards before putting your orders in the markets. And 3, hide your stop loss or stop profit orders behind prior swing highs or prior swing lows. Once you start using market structure to your advantage, you'll be surprised how many times your stop orders survive by a few pips. Happens to me all the time. Do I get stopped out? Sure. But there's lots of times where I don't get stopped out by a pip or two, and it's market structure that saved me. So really, do your homework and learn market structure. Okay, this is a brand new one that we're going to look at. We're going to talk about, that was a little more short-term oriented, 20-minute bars. This is much more about market structure, changes in behavior. We will talk about trade entries and money management, but it's a bigger picture for those of you that portfolio trade, or if you just want to learn about market structure, which is extremely important. If you can learn good money management and market structure, your trading will improve immensely. And let's see if we can get through this and make some sense out of it. I literally, if you can have Cynthia, I literally finished writing this about 36 hours ago to her consternation. So the market is cascading lower, making lower highs and lower lows. This is a 240-minute chart in the Euro FX against the dollar. And you can see we're making lower highs and lower lows. It's a beautiful chart. We take out this prior low. Now take a look. 2 things happen here that are important. We come up, we make a higher low, then we start to take out prior highs, and we take out 2 prior swing highs here. That's the first clue that maybe something has changed. When I see that happen, I draw in a blue upsloping median line and its parallels to show me the probable path of price. I'm not ready to trade yet. In the back of my mind, I got an itch, and it says, hey, if that was the bottom, what's the probable path of price? Well, that's what a median line is for. It's a leading indicator. It shows you the probable path of price by picking alternating pivots, the low, the high, and the low. And we've got the probable path should oscillate around this median line now. So now I notice that price has poked through the median line that I just added. And one of my favorite tools that I use, this is a 240-minute chart in the Euro FX. One of the tools that I use all the time is sliding parallels, and I'll take a sliding parallel. I use it the first time price pokes through, and I'll put it right at that low. If price closes twice below the sliding parallel, I'll just reject the whole sliding parallel idea and be done with it. You can see in this case, we came down, we did move below it, but we closed right back above it. So for me, the sliding parallel now should act as support. If I get 2 closes below it, I'm just going to erase it. I'm not going to draw a new one lower. I'm done with sliding parallels if I get 2 closes below this one. That's how I think. Other people use them different. That's how I use them. So I've got this sliding parallel. It says to me this median line has either shifted this amount or there's this amount of noise in this median line, but this sliding parallel should be the support, not this lower median line parallel here. Oop, what did I do? Okay. When price comes back down to test the lower parallel, it broke below again but stopped again at the sliding parallel I added earlier. Every time you see it test these lines, you get more and more confident. Let me just plant an idea in your mind. Anywhere in here now, because you're confident of these lines and you seem to be taking out prior highs, here we took out another prior high. Should we be thinking about a long with a small stop? Price tries to break and hold below the lower parallel, but below the lower parallel, but the sliding parallel acts as solid support again. You can get long here with a stop underneath if you didn't want to do it the third time. Note that price closes near its highs. Look at the close on this bar. Well back above the lower parallel. That tells you the buyers are in control. Every time it gets below here, the buyers come back in and take control of this market. Pardon me. Price begins to pull away from the support of the lower parallel and its sliding parallel. And we're taking out, look at all the swing highs we're taking out here. If you're just drawing in the median line now, you're coming to the party mighty late. That's why it pays to think in advance. You can always draw it and erase it if you're wrong, if it takes out this C point. Draw them earlier, and then if it starts to slide up, you're already action-jackson down here, so to speak. There's things you can do down here. Price gaps open higher above a prior swing high. This is a sign of strength, and you start to see prices gapping in the direction of the trend that they're moving. Price fills the gap and sells off. That's normal. But it's unable to test the lower parallel or even the sliding parallel, leaving double bottoms. And again, look at the close back above the middle part of the bar. Even on these pokes lower, there are still plenty of buyers in this market. Price consolidated at the multi-top line, which is right off of here. This is the prior high. And then, at this multi-top high, we consolidated right above it. And then made a new high for this move, and it tested the prior high, which is the dotted line. Somebody's asked me where my entry is. I wasn't giving you a specific entry yet. We'll talk about that in a minute. These are the major swing lows that spawned during this move higher. It says furring. Apparently, I can't write. These are the major swings that we've taken out, and you should be able to identify them. What's important? These are major swing lows. This is where limit buyers will be. They first want to buy here. Now they 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 want to buy here. Why do you want to know that? Because if you're long, you could put your stop loss orders underneath each one of these prior swing lows. Price continues to make new highs. It breaks above the prior swing, major swing high here. You can see it's just racing off. Look where it closes on its highs. And again, we've got new higher swing lows. So we're making higher highs and higher lows. This is a rip-roaring trend. Now, over the weekend, look at this gap higher. How'd you like this if you're long? Happy birthday. The gap's open. Does it stay open? Yes, it does. The gap open is a huge sign of strength at the moment. The gap remains unfilled and price runs higher to test the upper median line parallel. Now me, if I'm long, this is a gift from the gods above. I'm taking my profits at the upper median line parallel because this is a runaway market and it's a measured move. And I know, from trading median lines for years and years and years, trees don't grow to the sky. Kids don't grow like weeds. There is a point where they start to slow down. I'm taking my money off the table. And look at how much money we're talking about here. A lot. If you bought a retest down here, either this one or this one, of the sliding parallel right in here, once you knew it was good, with a small initial stop loss order, less than 50 pips, hit your stop off order and just hit your stop under these prior lows all the way up that I showed earlier, your profit when we reach the upper median line parallel would have been well over 1,000 pips. And you never took any heat on this trade ever, ever. Let's take a look and see what the market does now. We consolidate in a nice range. 1,000 pips, yeah, it's all good, isn't it, Cal? We consolidate in this nice range. It's a nice horizontal range. And then suddenly we break through a prior swing low. Now take a look all the way up. We haven't violated one swing low for more than 1,200 pips higher. All of a sudden, we break below prior swing lows. And look where we close, almost on the low. And we're back in the gap. This is a major change in behavior. When you see this, you need to be thinking something's different. Let's take a look. Classic energy coils or trading ranges occur after price has run out of directional energy. And where did it run out of directional energy? Right at the upper median line parallel, which is what the theory of median line says. And the upper median line parallel, if it's upsloping, you should run out of upside directional energy. On the lower median line parallel, that's where you should run out of downside directional energy. I prefer energy coils to have at least 5 touches, and you can see here we have at least 5. 3 on one side, 2 on the other. But note, in this case, price begins making distinctly lower highs, about halfway through the range, and that might be a clue to you. And it certainly, this is getting hit over the head when it blows below these 2 prior swing lows and closes on its lows in the gap. You know that something has happened here. And, of course, obviously, we've also fallen from almost 138 down to 134, right? So, pretty easy. And 1, 2, 3, absolutely. 3 drives to the top, no doubt about it. Price comes off. This is our gap. Now we sell off and we test this lower median line parallel, which held before. You want to get long here this first time? That's fine. But there's no stop. I'm not interested. If you want to just make, I call this a naked long, a naked test of this line. I'm not interested because your stop is all the way down here. It's 200 pips lower. I'm not interested in that. Although, look, it held nicely. You can paper trade and pretend you're going to buy these. But if you do them in real time, if there's no stop, where are you going to put your stop? You're going to put a cash stop. You can do it. I think you're better off hiding underneath market structure. You'll get saved a lot of times by buy orders in the market. Then we came back and retested this same lower median line parallel. If you want to buy it, the stop loss order would be 85 pips. Even though caught a nice big move here, 85 pips I'm thinking is a bit rich for me, not that interested at this point. I haven't seen enough strength. For me, I wanted to start to take out some prior swing highs, show me some strength before I'm going to spend 85 pips. That's a big stop for me, even though this line is doing exactly what it's supposed to do. Now we come down a third time, and we have taken some swings out. So do I want to get long? Price is testing the lower parallel again after failing to break above the trading range. Now, we tried to get above into this trading range, and we can't get in there. And we've fallen back below the bottom end. It was the support. Now it's become resistance. It couldn't get up there. It can't stay up there. Now we're back against this lower median line parallel. Note the close of this last bar is right on this blue upsloping line. I call that separation. That tells me the buyers are certainly not in control. The sellers probably are in control. I'm not sure that this is the place to go long. What do? I want to do what's called buying another bar. I want to buy another bar and see what happens. Let me see what happens. Oops. Buying another bar was a great idea when price closed on the lower parallel because it told me that there weren't a lot of buyers in the area. Exactly. I ducked a bullet. Now I'm looking at this structure, and I see this momentous energy coil sitting here and this huge change of direction. And I say, well, where's the next major structure? The next major structure is all the way down here at this multi-top bar, which comes off of prior highs and I just stretched it all the way along in the uptrend. There's very little to use as support other than this at the moment. Now, is this line going to come into play? I have no idea at that point. We're a long ways away. I'm not even sure what I'm going to do yet. But buy another bar means I'm just going to wait for another bar to unfold for the energy to be clear. So I'm going to wait another 240 minutes. That's exactly right. So what do? I'm not clear, so I draw in a median line to go, what is the probable path of price? Because that's a good leading indicator tool that I use. So I go from the highest high, the lowest touch, happens to be on the lower median line parallel. I call this being forced, to the highest high that we've made since. There's nothing magic in my choice of pivots here. You know, sometimes I get emails saying, I can't trade with median lines because the pivot choice is so hard to make. There's no magic here. Highest high, lowest low, highest high. Just go with those. Don't do anything fancy. Here's the median line. It shows you, take a look, price should oscillate around this median line. I like it when price forces these pivots. It tells me this median line is probably going to be an important one. And in this case, all the pivots are forced by the highest high, by the touch at the lower median line parallel, and by the double tops here at the major swing high. It has everything I like. I don't know what I'm going to do with it yet, but it has everything I like, and I think it'll show me the probable path of price. So here we go. Price approached but failed to test the bottom of the prior range. So it came back up. We tried to get up there. We can't get it. And look, we just missed getting up to test it again here. This is a sign of weakness. Price broke above the upper parallel but closed well below it. See where it closed? 2 bars later. So I draw a sliding parallel just like I did in the first example from that first bar's high. Notice I didn't draw it off the high of this move. I don't do that. I draw off the first bar that pokes through. Because otherwise you can continually be moving this line out, the line in the sand out, and just be cheating and cheating and cheating. So I draw off the first poke through. And if it violates that and closes 2 bars past that, I'm not interested in using it, any sliding parallels on this example, whenever I trade. Excuse me. So here's what I want to do. I want to sell a retest of the sliding parallel with a stop above the prior high and the bottom of the prior range. This was support. It should act as resistance. I want to be above the swing high and just above the bottom of this range is going to be my initial stop loss order. If I manage to get short, I want to buy at this multi-top line. That's the next area of structure that I have. And by the way, it also coincides or is confluent with the median line, which is where price should run out of energy. So let's see what we get. Price comes, you can see it pokes through, gets well past the sliding parallel, fills me, doesn't get anywhere near my stop, but gets nicely through it. Look where it closes though. Nice close near the bottom of its bar. Sign that sellers are in control. Now we start to move away from price action. I've got nice profits built into this. At this point, if I don't go above this swing high, and I can't yet, I got to go to at least break even. Now I can move my stop profit above the wide range bar top instead of break even. We take out those lows, and this becomes a swing high. So I'm short at the sliding parallel. You can see I'm just moving my stop profit down every time it leaves a new swing high. When we come down and take out this low with this bar, that makes these highs new swing highs. I just snug my profit stop lower. My profit target again is going to be right here at the multi-top line. What happens again? Now we cascade lower quickly. We've got a new swing high. When we take out those lows, my stop profit's now going to be above this new swing high. I'm just going to keep boxing in profits. We make one more fall. I don't get a chance to move again. And we get down right at my profit target. I netted 475 pips on this trade, never took any heat. All I had to do is A, get in on a sliding parallel. B, just use the market structure to hide my stops behind. I was never in any danger. Let's see what the market did. Well, we blew through that line, by the way. Look where we went. And could I have been cheaper? Sure, absolutely. I don't care. I got my planned profits out. That's all that matters to me. That being said, if you wait again for a change in direction, and here you can see it, as soon as it takes out this prior high, now draw in a new upsloping median line, and look what it gave you, the same trade. Now, there's no stop on this trade, so I probably wouldn't have taken it. Some traders that trade with cash stops might have taken this trade, and they would have got rewarded in the morning, and look at this, all you had to do is hide underneath the swing lows. I'm not going to lie to you, I wouldn't take this trade because the stop is all the way underneath here. I only take trades when I can hide them under structure unless I'm fishing for portfolio trades, which is not what we're talking about here today. So you can see, if you can learn about market structure and you can learn about using money management and using the market structure to hide your stops on both sides, you can really improve your trading drastically. All right, Cynthia.
Hello, Tim. Okay. Before I know there are questions and answers and Tim's got the answers. And while you're entering them into the chat panel, IB's management has asked me to run a poll just to get the feedback and determine if these types of sessions are relevant to what it is that you're looking for. So notice I'm going to open up a poll on the screen right now. It's only going to be there for about 30 seconds, but I would appreciate it if you'd answer those 3 short questions. As soon as you do, simply click the, did the poll open? I'm sorry, Tim, I need the ball.
Oh, I'm sorry.
Oh, that's okay. I'm the only one who can do it.
Can't you grab it?
There, I've got it now. Okay, now the poll is opening. Okay, I'm not on the ball today. No, and so everyone, if you can please indicate your answer to these 3 questions, we're going to actually give Tim an opportunity to review any questions, and we'll get back to his answers in just a moment. So make sure you click the submit button. There's about 20 seconds left. Also, notice question number 2 is an input box, and if there are other topics that you'd like to see, that's actually very helpful for me, because we will try and, I do review this with management and try to provide you with those topics that are requested. So thanks, everyone. 5 seconds left, so click your submit button now. Also, in just a moment, okay, the poll has ended, so I thank everyone for your participation. That actually is very helpful. But notice there is an arrowhead right next to the title bar of the polling panel. That actually allows you to collapse the polling panel so that you can get back to the chat panel and submit any questions. And so what I'm going to do is actually turn this back over to Tim. Thank you very much for your assistance on that, everyone. And this time I am going to be on the ball and pass Tim the ball back. So by the way, if your chat panel collapsed, notice if you're not able to see the chat panel, it's probably just the title bar that's showing at the bottom on the right-hand side. Double-click that title bar and it will reestablish the chat panel so that you can send Tim your questions.
I'm seeing, can you guys hear me now? Cynthia, can you hear me?
Yes, we can.
Okay, good. Yeah, lots of great questions. Thank you. Let's see, I got a couple privately. Let's see. Why did I use 20-minute bars on the Canada? Well, the international standard, if you will, for large hedge funds traders is 240-minute bars, in my opinion. And if you want to break it into a frequency of that, you can go down to 20-minute bars. I also sometimes use range bars. I very seldom use 15 or 30 or 60. But, you know, if you're stuck on, if you're using Metastock or MetaTrader or, not Metastock, MetaTrader or one of the other platforms that only goes 15, 30, 60, there's not a particularly huge difference in the charts. The most important thing is market structure and money management. And if you just do that, you're all good. Let's see. Somebody said they love it when Cynthia runs the webinar. I absolutely agree. She is the best. She gives the best webinar, so to speak. And take that as a compliment, Cynthia. I mean.
Well, Tim, I think that's because I've brought you on today, so that actually elevates my position here. So it's a double whammy. But thank you.
Okay. I do have somebody asked if I have a book on the basis of drawing forex. Yes, I do. It's it's right there in front of you. Medianline.com or marketgeometries.com. If you go to either one, there's a link for books. And I'm not here to sell books or anything else. I'm just here to try and help people understand market structure, and let's see if we can get everybody on the right page here. Can you explain how to set the first median line? Martin wants to know. Well, I just use the majors. If I were you and I was learning about median lines, I would use the major high, and lower low, high, low. They always have to be alternating pivots. And I wouldn't mess around with stuff that's inside. People will see me use sometimes what I call a with median line or something else. Or just don't even mess with that stuff. Start out and master just the major pivots, and you can find lots of trades off of those. Then you can always move on to other median lines later on. Let's see. If price keeps testing a lower median line or a higher upper median line parallel, does that mean that the valid or one has to let it go, no trade? It's a good question. It kind of depends on the circumstance, and I guess the way to think about it is this way. If it's testing the lower median line parallel, as we saw in that first example in the euro, it tested it for quite a while from up above. It was testing that lower upsloping lower median line parallel from up above, but yet it continued to take out swing highs. If it continues to take out swing highs, I'm not going to run away from the trade. If it's not taking out swing highs, but it's just kind of dribbling along that lower median line parallel, then I'm going to start to get worried. So it kind of depends on what it's doing at market structure. Let's see. What range bars do I like to use on the currencies? I'm not, it's not necessarily because they're Fibonacci numbers or geometric numbers, geometric expansion numbers, Euclid numbers, whatever you want to call them. It's more just that they're less than doubling and more than halves, which is I use the fib ratios. I use 8-tick range bars, 13-tick range bars, 21, 34, 55, 89. My favorites at the moment are 21 and 34s. If the market moved down to where we were a lot more range bound, I'd ratchet it all the way down to 8-tick range bars. I trade a little bit wider at the moment. Things are a little wilder at the moment. Let's see. Let's see. David says, why do you attach significance to the bar closes as surely the end points of the intraday bars are arbitrary? Actually, they're not arbitrary. We've done a lot of statistical studies. That's an interesting question. They're actually not arbitrary. We have a tool called VolveForce that was set up after doing a lot of work with the database, and we take a look at the last 10% of the bars versus spreading, and you can change the bars to an arbitrary number or have the machine do it randomly, and you can take a look as the bars change in the last 10%. You can tell who's in control by who's buying the offer and who's hitting the bid, the aggressive buyers and sellers. They're not particularly arbitrary, actually. So there is something extremely important about closes of bars. Any good book on Fibonacci? I would buy something from Joe DiNapoli, a good friend, and somebody that I think gives good seminar and also is a good trader. Tell Joe I said hi. How often do you use the 382 for entry or stops, as the example was used in the first example, but not the second? I hope that makes sense. Yes, it makes perfect sense. When it's available. I'll lean on it when it's available. It's not that often that it's available. I've used it a couple times this week, actually. It's worked nicely a couple times this week. Kind of just depends on if it's available. You use the tools and the market structure that's there for you to use. Could I use the zigzag indicator in MetaTrader to give the pivot lines? Would that be a good way for a beginner to find the major pivots? Sure, absolutely. There are better ways once you get more mature, so to speak, but that's a great way to start out, absolutely. What range of time frames do you use for the E-mini S&Ps and S&P futures? I use either 10,000 contracts per bar or 2,000 ticks per bar, or I use day-only 39-minute bars that start at 8:30 and close at 3 o'clock in the afternoon. I know that sounds confusing, but remember the E-mini S&P futures go in their day session go from 8:30 to 3:15. I lop off that last 15 minutes to make it the same as cash. That leaves 390 minutes. I divide it by 10. That gives me 39 minutes. Let's see. Carlos wants to know, will I put up several different time frames of the same instrument when fishing for a trade in that particular instrument? Or do I prescribe one chart at a time, one time frame? Yes, I would rather have one chart, one time frame. I respect Dr. Elder, but I think he's done a lot of damage to a lot of beginning traders to suggest that they should be looking at 3 or 4 time frames at once. I think they get too confused and try and talk themselves out of, well, it's in an uptrend in the 5-minute, but it's in a downtrend in the 40-minute, and it's in the daily. It's this. At that point, you're just so lost, forget it. I think price will tell you on whatever time frame you're at when it's turning if you pay attention to price. The problem is most people don't pay attention to price. So pay attention to price, pay attention to structure, and you don't need anything other than one. Vol Force Donna says, what is it? It has to do with AutoForks 2. You don't need to know, but if you want to know, drop me an email. It's an indicator that we have an AutoForks 2. I didn't mean to use the name as a come and see it. It's a statistical study we did to take a look at the meaning of where bars close. Eddie says, the pivot that you drew, was it the same as the Andrews pitchfork in Metastock? Well, the pitchfork tool that I used was actually in Ensign today, and it is certainly the same as in Metastock, so you should be okay. And Metastock has been around forever. I'm sure their pitchfork tool is fine. I did not use a modified shift today or any of the other fancy pitchforks that are available in the world. I used only traditional median lines and then a sliding parallel, which you can draw as a parallel line to it. So there's nothing special about that. More details, Jorgen wants to know on bars eliminating time. Well, if you trade things, for example, like the E-mini S&Ps or the bonds particularly, or oil and gold, there are periods where they just go flat in the water, yet they have important highs or lows, like overnight. So you want those highs or lows to be included, but you don't want the dead period to skew your charts. So one way to do that is to take out time, either by going to a dollar. For example, in oil, I like $1.90 from the high to the low of each bar as a range bar. Or in the E-mini S&Ps, I'll use number of contracts. Or in bonds, I might use 352 ticks per bar in a bond chart, which is equivalent to about 15 minutes worth of action in a normal market. And that allows me to have the entire 24-hour period and not have that dead period where there's nothing going on, skew it by the computer putting out a bar every 15 minutes. Instead, I'll have just nice, easy-flowing charts. Let's see. Dave says, does it bother you that non-time bars have an inherent nonlinear geometry, so how can they define something by projection forwards? No. Listen, you have to plot them against something, and there's been a lot of work done recently by some very fascinating physicists, some that I know and work well with, that says time is an illusion. So we're at this point, if you're not going against time, if you're not charting against time, you're charting against space. Think of it that way. It's just a different what's the right way to say it? It's a different dimension, and I do work in 5 and 6 dimensions actually. Keith says, initially you said you wouldn't take the trade because the market structure wasn't close enough to hide your stop. I thought you would use below the median line of support to hide your stop. No, underneath the median line for me is not enough. Is not market structure. That's where price should stop, but that's not market structure. Because remember, 99.99% of the world is not going to have that median line, so they're not going to have their limit buy or sell orders there. I want to be underneath a swing high or a swing low, or the high of a range or the low of a range, or at a fib number where all you guys are going to be hiding your stops. Let's see. What's the best time frames for forks? Median lines were originally developed by Dr. Andrews in the mid-1920s. He used them on dailies, weeklies, and monthlies to trade stocks. He made more than $450 million for Joseph Kennedy, so the older Kennedy. That's where they got their first fortune during the Depression. And so, I mean, it was originally traded for stocks. He worked for Frank Andrews and Son. And so it works on dailies, weeklies, monthlies. I've certainly shown you 20s, 240s. I traded on everything from 8-tick range bars all the way up to weeklies and monthlies. So it works on everything in any market. Am I a session trader or a day trader? Not sure what that means, but let me put it to you this way. I have a portfolio that I trade, and then I also intraday trade 2 to 3 days a week. I don't have the luxury any longer. With the speaking I do and the writing I do, I don't have the luxury to day trade every way, nor do I, to be honest, nor do I have to. But I do day trade 2 or 3 times a week when I like the market conditions. But I also portfolio trade about 27 different things. If price fails to reach a median line and takes out prior structure, say if you're long and stopped out of your position, would that caution you to look for any further long entries back to the lower median line as something has changed in price behavior and likely to breach the upsloping pitchfork? Yes, that's called the Hagopian rule. Not to get too technical, but basically it's a warning that price may not be doing what it's supposed to do. And then if it takes out the prior most likely line underneath it, it's going to travel further in the prior direction. So yes, that is a warning, absolutely. Let's see. Do I prefer tick bars or range bars, Mike says. Tick bars, range bars, it depends on the market. And what I do is I'll look at, for example, in the E-mini S&Ps, there are no range bars that I like. Now, my partner, Stuart Miller, likes range bars in the E-mini S&Ps. I don't. I just don't like the way they look. They look too chunky to me. I like charts that flow and look pretty. But I like 2,000 tick, and I also like 10,000 contracts per bar. So it depends on the flavor and how it's setting up that day. If I pull up a 10,000 contract bar chart and it doesn't look good to me, I'll go to 2,000 ticks. What if I have to change futures contract and there's a jump from 1 month to the next? Somebody asks. Well, the first thing is, if I'm trading E-mini S&Ps, I don't trade E-mini S&Ps the day after rollover. I wait a day or two and I let market structure catch up. But that being said, there's plenty of, I mean, if you're dying to trade, you can trade that prior front month for another day or two, and there's plenty of liquidity for most things. If you're trading currencies, they fill in pretty fast. Same thing with bonds. Do your rules allow you to only take trades long with upsloping forks and short with downsloping forks? That's absolutely true. You get a 10% edge for trading with the line, with the slope of the lines, with trading with the trend, so to speak. So I basically, I mean, I could take the other side, but remember, if I'm short against downsloping lines, I mean upsloping lines, so I'm short against upsloping lines, the resistance is always moving against me. I call it getting collared. You're better off trading with the trend. You get a 10% edge. Let's see. What makes good market conditions to day trade? Well, for example, I don't trade very often on a Fed day. I have better things to do. I'll come back in as soon as the Fed announcement's done, look, wait for the market volatility to slow down, and then jump in. If you guys got to go, you got to go. I understand it's late. Thank you for taking your time. But if I come in and I look at the markets and it looks like the market's having normal volatility, and I see some interesting things, I'll sit down and day trade for 3, 4, 5 hours. And I'll watch. I tend to watch 3 to 5 markets, 2 or 3 currencies, one of the stock market indexes and bonds. If I'm stalking a trade in one of them, I don't pay attention to any of the other ones when I'm day trading, and I'll just watch those. My portfolio trades, I don't pay attention to them at all during the day. I pay attention to them at 4:30 in the afternoon when I hand chart. So for me, day trading conditions are when I sit down, I like normal volatility. I don't like abnormally wild markets. Is volatility a feel you have or something mathematical? Well, for me, I can just look at a chart and say, oh, my God, well, you've seen the E-mini S&Ps. You open it up and they're up 35 handles and the market's about to open. It's pretty obvious that's not going to be a normal day. I probably would trade a different market. Let's see. There's somebody that, if somebody wants to know about prop shops, drop me an email would be my advice to you. How's that? Rather than have me do it over the air. Somebody says, privately, I tend to be stopped out placing stops out of range just to see the price come back, false breakouts. I guess my question to you would be, are you using market structure? You need to be thank you for the praise. I appreciate you taking time. You need to be some measure of volatility above swing highs if it's your stop loss. You need to be some measure of volatility below if it's a swing low. In the currencies, I use at minimum of 5 to 7 pips or ticks. In the bonds, I use about 5 to 7 ticks or pips. You'll see me use wider ones sometimes. In the E-mini S&Ps, I use at least 3 ticks, which is 3/4 of a handle or 1 tick less than a full handle or point in the E-mini S&Ps. Do I use daily pivot points? I do not use daily pivot points. I don't use any really any indicators other than leading indicators. Pivot points in my opinion, were more interesting when the guys on the floor paid $50 a day to buy them from the old ladies that walked around the pits and sold them, so everybody was looking at the same pivot point. But unfortunately, there's only 10 or 20 people in the S&P pit these days that use them, so I don't use them. If they work for you, use them. They don't. I don't see the need for them myself. Keith Christie wants to know, would I comment again on the 5 touches you look for in a range? No, my point was, look, don't take that as gospel. It's just when I am looking at a range, one of the things I like, I'll call it an energy coil. I'll upgrade it from a range to an energy coil if I get 5 touches, 2 on one side and 3 on the other. That makes me think that at that point, price has restored the energy that it took to run up and now form that coil. You should think about it this way. It's like going to the gas station. Price made a long ride in the car. It ran out of gas in the tank. Now it drives into the gas station. It trades in a coil while it fills its tank. When you get the 5 touches at that point, as far as I'm concerned, I'm looking for price to do its thing and move out. Let me see. Have I missed you? If I have, type it in now, and we'll go ahead and try and answer. I'm doing my best. Do I use candlestick bars? Do I like them? I've used them in the past, Don, but to be honest, and I don't want to sound like an old fogey. If anybody knows, I'm 51. I'm not that old. But at this point, actually, I actually just use straight. You're looking exactly at what I use, and especially those of you that have seen my morning sessions. If you don't know, I give a free morning session every Monday, and the Merck is the sponsor, so you can find it on the CME calendar. At 6:30 in the morning, you can come watch me chart for an hour. I chart currencies, commodities, and E-mini S&Ps. You can come and watch and see exactly what I use. And I just mark my charts up from flat and talk about structure, and we go through the whole thing. And so anyway, I actually don't use candlesticks because to me I don't need them, and I'd rather know exactly where the bar is moving, where the high and low is. They clutter up my chart. But if they work for you, if they visually help you identify, for example, a good friend of mine is Dan Gramsa, and Dan Gramsa does a great job of showing how to use candlesticks in the same way that I use median lines to frame the market. Dan Gramsa uses median lines to help him frame the market. I'm all good with that, and you can certainly use median lines with candlesticks or any other kind of bars. In fact, a good friend of mine, a tremendous trader, uses point and figure, and then puts median lines right on top of it, pitchforks right on top of point and figure. Let's see. 38%, 38.2%, or 50%, which is better to buy or sell? Here's what I do. If we're in a downtrend and we can't rally above the 38.2%, it's very weak. If it breaks above the 38.2%, I'm neutral on that market. I'm not bullish. I'm just neutral. 50% is a sometimes stopping point, so I'll pay attention because a lot of traders are looking at 50%. Same with 61.8, but to me there's nothing magical on those two as far as I'm concerned. What I want to know is in a downtrend, if it can't get above 38.2%, it's still very weak, and I'm looking to enter a short. And an uptrend, if it can't get down below the 38.2, I'm exactly the opposite. Can you look at market structure on oil charts after 1, 2, 3? Why take trades that are not on a lower median line? I think that's probably best answered if I have the chart up, which I don't. I'm sorry. You can send me an email and I'll resend you the chart. Brian wants to know, how would I suggest someone pick markets to trade? It can be overwhelming to try and look at all of them. Yes, do not try to trade too many. If I were starting out, I would start out with 1 or 2 markets and try and get their personality or flavor. If you don't like it, move on to a different market. If you had some modicum of experience, meaning 6, 8, 10 months, and we're still struggling with success, but you're hanging in there, I'd think about, like I said, take care, Jerry. Thank you for coming. What I would think about at that point is 3 to 5 markets. You get much above that, you're starting to get lost until you get very experienced and can wade through it. And I look at, like I said, 2 or 3 currencies. What I like is a trending currency and 1 or 2 that range trade. I try to look at, right now, I tend to look at the euro against the dollar, then I'll look at the Canada, and I'll look at the Aussie. Those are, because the Aussie and the Canada have just been rocking lately. And plus, on top of that, I get nice range trades out of the Aussie and Canada as well. So if I sit up there and I see a nice range trade coming, I'm not afraid to take a range trade. Then I'll throw in a stock market. I'll throw in either the E-mini S&P or the NASDAQ now that its ranges have gotten larger. And by the way, I do not trade the Russell. And then on top of that, I'll throw the bonds in there. Question spawned from the second example where price was in a range and down-sloping pitchfork could have been used. I must have missed the first part. there you go. Price is in a range. Do you prefer to line trade or trade off a median line, upper or lower median line? Does price action dictate? Price action dictates if you can get both things going for you, meaning if you're at an upper median line parallel that's down sloping and also the top of the range trying to get short, that would be your best, the best of all worlds, so to speak. And also the size of the stop is important. I have a maximum amount of stop that I'll use. I literally write a check out in the air. I know how much per contract I'm willing to risk. If I start to write out a check that's more, and guys in the prop room when they watch me trade in Chicago laugh, but that's how I do it. I've always done it that way. And when I start to write out a check that's larger than that amount, then I just don't take the trade, and I make myself do it every trade. It's a little cue that I use for myself. Mark wants to know, do I have a regard for any other known traders who use forks, but not necessarily the way you use them? I don't think it's a fair question. I'm not going to answer it. Yes, Dr. Andrews. How's that? Fault other participants. When do you erase a pitchfork that shows no hits but still has a leg that could be hit? Well, if it's not showing any hits, you're probably, unless it's very early on, you should be taking a look at other swings. Maybe go back a few swings, maybe try a different BC point. If you're not getting any action at all, there's no use in holding the pitchfork up there. You can leave it up there while you look, but I don't think I could do. What's the difference, if any, between U.S. CAD and CAD U.S.? It just depends. Donna wants to know. It just depends on how you're quoting it. The IMM, excuse me, I'm an old man. The IMM is what we used to call it. It's now the CME group. The CME quotes it one way, which is upside down relative to the cash world. The cash world quotes it the other way. That's all. It's the same currency pair. What's been my average monthly, yearly % return since you perfected using these pitchforks against multiple markets you mentioned? If you really want to know, in 38 years, I'm at about 34 or 35% rate of return on an average annual basis. And I'm at 3.5 to 1 on risk-reward ratio. Do you only take trades that give you a minimum of 3 to 1 risk-reward ratio? Actually, my minimum is 2 to 1, but it's got to be pretty darn good looking if it's only 2 to 1. And that's why my risk-reward ratio is higher than that. On top of that, if you get some runners that give you a 5, 6, 7, 8, it starts to tend to push up your risk-reward ratio. But if it's less than 2 to 1, I just don't take them. What's the best way to learn pitchforks? I would go to either one of these websites in front of you, marketgeometry.com or medianline.com. You don't have to buy anything. There's a ton of free information, including Dr. Andrews' original course from 1965. He charged $1,500 a copy for it. It's there free for you to read. There's all kinds of papers from me and other people. There's a free forum there. If you want to do the work, you can learn just by digging through either one of those spots without spending a dime, and that's fine with me too. That's why it's up there. What else do we have?
Well, Tim, Cynthia here. I certainly appreciate this lightning round of questions and answers. Boy, and you're batting them out of the ballpark. So definitely appreciate this. And I think we could probably go all night. There's so much interest in this. So what I am going to do, and I apologize to everyone, I'm going to try and cut this off right now. And I want to thank everyone. This has been a superb event. And Tim, thank you for capping off a day of trading around the world. That is just fantastic. And with that, we're going to go ahead and end today's event, or bring today's event to a conclusion. But I do want to let everyone know today's the entire presentation has been recorded, and you'll actually be receiving a link to the recorded playback sometime later on. It actually takes me a few hours to compile and upload it to our servers, but as soon as it becomes available, you'll actually get access to it. There's so much information here that you have an opportunity to go back and review any of this information whenever it's convenient for you. So I have to also thank the CME for coordinating and helping in the production of this terrific day of trading. This really has been phenomenal for us. So thank you, and thank everyone. I see quite a few names that I've seen throughout today in all of these events. So a lot of interest has been generated. So thank you all for your participation. Now, there is one last favor that I'd like to ask those of you who are on the session. As you exit the event, my boss actually asked for a marketing survey. Trust me, it will take about 5 or 10 seconds to simply make your selections and submit. It's an anonymous survey, but it will help us out, so I'd appreciate just a quick response. That's helpful. So thank you all for joining us here this afternoon. Watch your email for links to today's event, and these will eventually be posted on the Interactive Broker website and archived there for your access as well. So thanks once more to Tim Mord for a terrific presentation today. Tim, we look forward to hearing a lot more from you, so thank you very much.
Thank you, Cynthia. You know what, I always have a great time anytime you invite me. If you ever have time and can use more presentations, I'm always here for you. I love it. Everything always goes on schedule, and you always have a great crowd. Thank you so much, and thank you all for the great questions, by the way. I appreciate you taking time.
This has been terrific, Tim, so thank you so much. I see some questions coming in. Anyone who missed any of the sessions that did occur today, we actually had 4 different events. If you did not register for it, simply send me an email, and my email will be included in the in today's playback information. So send me an email. I'm happy to share with you both the presentation and the recording link to any of our events today. Thanks very much to Barbara Schmidt-Daly and Mike Homan with the CME for providing our event today. So with that, I'm going to wish everyone a good night. Have a great evening all, and remember, trade smart. Thanks all.